My name is Jacob Moffett, and I am here for the essay number 4 presentation over the certain facts that we were given in class. Now, as we look at the certain facts that I was given, there is a newspaper company that currently has 10 claims being processed against them. Of those 10, 2 claims are likely to be successful. There is also the chance that 5 more claims can be brought up for certain articles that have been written where there is thought of to be incorrect facts listed in the articles. Now, we need to really think about when should we start to recognize these liabilities and how can we provide the most useful information to the users on the financial statements, which is the entire purpose of financial accounting in the first place. And in order to do this, we really need to understand what a liability truly is. Now, as we turn to the FASB concept statement number 6, we can see the definition of what a liability is right there. But one of the key parts of the entire definition is that liabilities are probable future sacrifices of economic benefits. The idea of probable to me means more than 50%. And so I agree with that definition, and it should not be considered a liability for the company to recognize until it is greater than 50%. This is a very important distinction to make because liabilities themselves show up on the balance sheet, they affect the assets and the outflows of the assets to pay for them, and they even affect the income statement in an effect that has to do with an expense having to be formed so the liability can be written off, and that would then show up on the income statement. So these have a direct impact on the financial statements that users will be receiving for the company. And as we look at the 3 key characteristics, we see that liabilities must have a specified or determinable date. And until a liability is probable, it would be very, very difficult to know when that date is going to come or when that liability must be paid. And so as we begin to think about the whole concept of when we should have this liability on our books, it is important to remember concept statement number 8 and the qualitative characteristics such as the predictive value under relevance. How are we really going to be able to give anything that has good predictive value if we believe that it is more likely to not happen than truly happen? So that's kind of where I keep going on with the ties of it is important to wait until it is probable. This also directly impacts the idea of faithful representation. And in order for the financial statements to be free from error, we need to keep from jumping to conclusions, keep from writing liabilities that are more likely not going to happen. And so this ties into the newspaper and when we should actually start to recognize these liabilities or possible liabilities that have been brought up. And so as we see, if there are no claims and no error, obviously there's going to be no liability. If there are no claims but errors are known, I still believe there is no liability because there is less than a 50% probability that any economic outflows of assets are going to be required to pay for those liabilities. They haven't been brought up, there's no specified date, and there's no way to measure how much is going to have to be paid at that time. If the claims have been filed, then we get into where we start, are they probable or not? And I understand this is going to be tough to determine when they think they should be paid, and it is most likely going to be a judgment call for the firm. But they need to start recognizing these liabilities when they can determine they are probable and know that there is a specified date and are able to measure the value of the liability and book that amount. And so that is how I think that these transactions should be handled. I think that the newspaper company should book liabilities for the 2 cases that are currently in court and the defendant or the plaintiff is likely to be successful. And